Okay, HDFC Bank just put out a stellar Q2 result. It definitely gave the SGX a good uptick this morning in anticipation of the bank nifty being invigorated. And indeed it has. You've now seen the likes of ICICI Bank, some PSU banks, all fairly charged up on the back of this HDFC result. It's really pointed the entire sector in a positive direction, and now investors are starting to think that the outcomes from the rest of Bank Nifty and the larger privates, as well as maybe an SBI, might not be that bad at all this time round, and that a lot of the fears were exaggerated, and hence the valuations that have also been compressed significantly actually stand to gain. Now let's analyze HDFC first, leaving the other banks out of it. Good result, aided a little bit by other income, but good profitability. Credit growing at 16%, deposits growing at 20%, NPAs in control. Even if you look at the pro forma numbers, which basically means HDFC decided to let the public know what the NPA figure would have been if that Supreme Court order putting a stay on NPA declaration had not come. So with that, the NPAs are still stable, and a 2,300 crore provision has already been taken against that. Collection efficiencies at 95% for Morat accounts. It's expected to touch 97% next month. For the non-Morat accounts, it's 99% collection efficiency. So where do you see metrics like this? It's basically almost every single customer has been able to pay up on time, and they have very little delinquency in their overall loan book and portfolio. So definitely a good, worthy result. Now on the back of that, you have upgrades. Bank of America maintains buy, target 1450 rupees per share. Q2 is likely the end of an accelerated COVID provision period. Profit should go up going forward. High collection efficiencies, restructuring requests are very low, and growth is almost back to pre-COVID levels, plus very strong retail trends. Morgan Stanley, target 1550 rupees per share, even higher. Target up from 1450 to 1550. Strong trends despite a very tough macro climate. Better than expected credit cost and treasury gains in Q2. We then have Macquarie, which put out a very interesting note, right? And they were perhaps the most comprehensive note that we saw come in this morning among all the brokers. And very interesting points. The first thing is what they liked was the collection efficiency, which we spoke of, right? Then what they're saying is that the H1 credit cost is 150 bips. They anticipate another 100 bips. So they've taken the full year credit cost to 250 bips. For next year, they've taken 200 bips. And for FY23, they've taken 140 bips. Each year, according to Macquarie, that the credit cost dips by 50 bips, HDFC earnings will shoot up by 15 to 20%. So if you believe that to be true and you think that can happen, then it's a no-brainer. It's a very positive remark made by Macquarie here. Very strong guidance on asset quality. They cater to the top of the end customers in every segment. No issue for their customers on the job loss front or on the salary cut front. So Macquarie, possibly the most bullish broker, and they're not too far behind Bank of America and Morgan Stanley. But nonetheless, even if you look at the stock price today, it's not corrected at all. It's held its ground. So I think the street is quite happy with HDFC Bank's Q2 FY21.